Good day, everybody. There's been some interesting moves on stocks since we last met a month ago. There's been a lot of volatility, and there's some big questions being pushed forward. And I think it's worth spending this time to have a little look at these questions. So, to be honest, stocks have had a pretty good 2023 so far. If we look at this chart on the bottom left here of the USA 500, the S&P, this rally from the March 12th lows is pretty impressive. These US markets have been the leaders, one of their longest streaks of monthly gains since August 2021. And this has driven sentiment higher as it sucks in more cash from the sidelines. We've seen some of these equity funds sucking in cash. We saw the DAX sort of being dragged higher, although some of the fundamentals in the European economy have not been that good. So there's this discussion really between a lot of people that do we have this Goldilocks scenario? And, basically what is that, which we'll discuss in a little while. But this is partly also due to FOMO, fear of missing out, and benchmark it. As stocks drive higher, asset managers have to be involved in the stock markets. Otherwise, due to benchmarking, they miss out. So what is this Goldilocks scenario? Obviously, it comes from, the fairy tale, stocks, the economy running not too hot, not too cold, just about perfect. Is that the case? I mean, this is the question. This is where inflation is falling and economic growth is still resilient. Now, to be honest, we have seen a situation where US economic data has actually been quite strong, but there are some canaries in the coal mine, some signals, red flag signals behind some of this data that are beginning to sort of bring this into question. But, if we look at US inflation on the chart on the bottom left here, wages are cooling slightly. We've got a situation here where the Fed potentially don't feel the need to hike interest rates any further. And the S&P Global Flash PMI on the right shows, really a little bit of weakness there, but potentially a bit of growth because the composite is above 50, although a 5-month low, it's still above 50. Services is above 50. The manufacturing is actually climbing a little bit. But this is a real problem because we don't quite know where we are and what the real impact of interest rate hikes has done on the economy. So this Goldilocks scenario is interesting, but I'm not sure it's guaranteed. So I think, when we move on to the following slides, we can actually answer some of these questions. So if we look at recent events and the impact on the stock rally, Wednesday, August 2nd, Fitch downgraded US debt. Now, this was initially a bit of a shock, but to be honest, this is quite right. It needed doing. It needs to highlight the US's huge debt burden as borrowing costs have risen. Interest rates going from 0% to 5% means that this debt financing problem is becoming a major issue. So, is this a short-term wobble we've seen in stocks? If we look at the Tech 100 chart, this is only up until the 2nd of August, by the way, and we've seen further losses recently. But you can see the market's turned over. And, this is a Fed that's still hiking. This is, some problems looking at some of the systemic issues with the banks. Not only were they downgrading the regional banks, they are threatening to sort of reduce the ratings on some of the major banks as well. So, the question is, can stocks shake this off over the summer? That's a good question. It's enough possibly to spark some profit taking. We look at the Fed because they are data dependent. And if we look at the data that we've had recently, on Friday, we saw non-farm payrolls. Now, a lot of people said this was a Goldilocks scenario for US stocks because we had wages still rising, but growth actually doing okay and the jobs market strong. But if we actually drill down into the data, not such good news. The unemployment rate and average hourly earnings are still a sticking point for the Fed. I get that. But if we look at the fall in full-time jobs, it was over 500,000 jobs in full-time jobs were lost. The reason why it wasn't picked up in the headline data is because part-time jobs increased. Now, the problem is that part-time jobs don't pay as well as full-time jobs. Now, I think this is why the market saw bonds sell off in that. So whilst the headline chart here on the left shows job growth remaining pretty steady in July, there's some interesting stuff going on underneath the hood that we need to consider. So have stock indices suddenly hit a bit of a wall going forwards? I think there's enough in the data to suggest that maybe some profit taking should be taken. So if we look at forward events, I mean, there's certain things we need to look at. Now, remember, the Fed is data dependent, and that means we have to be as well. So you need your economic calendar to see what data is coming up. Now, straight away, tomorrow on Thursday, this is August the 10th, we're looking at CPI data out of the US. This is a big number. This is a hugely important number for the tone of the dollar, for equity markets, for bond markets, for commodity markets, just about everything. So the market is actually looking to see inflation actually move slightly back up. This is a bit of a concern. If it moves up more than expected, then look out, because everybody thought inflation is beaten. But you have to remember that inflation moves in waves, and there is a danger here that we could see, due to base effects falling off over the last few months, that we see inflation start to rise again. That is going to catch the bond markets out. We need to be careful of this. So not only do we get the CPI data tomorrow, which is August the 10th, but later on at the end of the month, we get PCE inflation as well. This is personal consumption expenditure. Now, this is the favored gauge of inflation of the Fed. So this matters clearly as much as CPI does. We also have another non-farm payrolls release due before the next Fed meeting, and CPI again on September the 13th, all before the FOMC rate decision and press conference on September the 20th. So there's a lot here going on that I think is going to be forming a long-term view of how market's going to react. This is really important stuff coming up. Now, we must remember that the central banks generally are data dependent now, and so these data matter, and it's important to understand what impact they may have. We're getting some mixed signals from the Fed speakers, but generally, you know, there is a discussion that possibly the Fed is going to hike again in September. Is that the case? Is that good for stocks? Probably not. The tech stocks, I think, are beginning to see enough signals in the market to suggest, look, why don't we take some profits here, sit back, let's see the summer through, enjoy ourselves, and come back in October or November. And I think there's a danger here that this rolls on a little bit, but certainly tomorrow's data, August the 10th, tomorrow's CPI data, could be a market changer. And I think we need to bear that in mind.